Hey everybody, welcome back to another episode of A Millennial's Guide to Real Estate Investing. Today I have Mark Roderick. He is one of the leading crowdfunding, investing, and fintech lawyers in the US. We're going to talk today about crowdfunding, blockchain, and then crowdfunding as it appears in real estate and also in law. So thanks for coming on the show today, Mark.
Thank you very much for having me.
No worries. I guess first let's just start with your story a little bit. So how did you get involved in real estate or real estate investing?
From representing real estate developers. So I've represented entrepreneurs a long time and like decades. And among the entrepreneurs, I've represented a lot of real estate developers. And like other entrepreneurs, but even more so, as you know, real estate folks are always looking to raise capital. You know, I always say that if you are ever in a conversation with a real estate developer who's not looking to raise capital, call 911 because he or she is no longer breathing. So they're always looking for capital. So I've been involved in helping them raise capital forever. And so that's how when the Jobs Act crowdfunding came on the radar, I realized, aha, this is going to be a super cool, disruptive, transformative deal. And in fact, when crowdfunding began, people thought that it was a sort of Silicon Valley phenomenon, that the companies raising money would be high tech, social media companies and so forth. And I actually wrote a blog post way back in the beginning saying, you know what, real estate would be a great asset class for crowdfunding. And it's not because of my blog post by any means, but as you also probably now know today, 95% or 90% at least of crowdfunding is real estate. So that is how it has turned out.
Yeah. And when did the whole crowdfunding and real estate actually, because the Jobs Act was passed when were people actually able to crowdfund the real estate?
The Jobs Act was passed in 2012, signed by President Obama. And but it was the law itself, sort of the effectiveness was deferred until the SEC, the Securities and Exchange Commission, wrote regulations. That began to happen in 2013. So the first kind of crowdfunding began in September of 2013, and then other kinds have been added. And real estate crowdfunding happened almost right away.
Yeah.
The Realty Mogul, I remember when Realty Mogul began, and it was this tiny site, like all the sites, and it was doing little fix and flips. And of course, fast forward last month, one of my clients actually closed on a $15 million equity round for a real estate project. So
wow,
that's a long distance traveled over just a few years.
Yeah. And can you explain how the crowdfunding for real estate works, like on the investor side, somebody investing into a crowdfunding, what is people are paid an equity position in those deals, or how are they paid out? Because I remember that crowdfunding started, a couple years or many years ago, let's say, and crowdfunding like Kickstarter and all that kind of stuff, but you weren't able to actually get equity in those companies. You could only, get a product or like the first, edition of X or Y, right? So when did that change? Was that just in the last couple of years? And then how does it work when people want to invest in a crowd? Like if I go to Realty Mogul today, how does that whole process work?
Yeah, so crowdfunding, I use the generic definition of anytime you're raising money online. So that's a pretty good, if you use that definition at a cocktail party, people think you're, really sound knowledgeable. And so we had the Kickstarter and Indiegogo version, and we call that, just by way of distinguishing it, donation or rewards-based crowdfunding, because that's what you get. You get a reward. You get a baseball cap. You get a watch, whatever. The In contrast, the word we use to describe what I do is equity crowdfunding, where you're actually making an investment. And that's what became legal with the Jobs Act that was signed in 2012. The other stuff, donation based, had already been legal and still is legal. It's very
Yeah.
simple. But the equity based crowdfunding is what became legal in 2012. And really, so like to your generation, this whole thing feels totally natural
Yeah.
because it's just the internet. And like everything you guys do, your whole life is, internet based, and you can't
Yeah.
even remember it being anything else. Like,
Yeah.
your girlfriend you found on whatever Match or Tinder,
Yeah.
whatever. You've never even thought about calling a taxi in your whole life,
Yeah.
right? It's just
Yeah.
Uber, and you never would think about booking a plane trip on anything other than kayak or one of the other ones. So, and that's all crowdfunding is. It's just the internet, just using the internet to raise money. That's it.
Yeah.
And I always say, fortunately, there are a lot of complicated legal rules, so people have to hire me.
Yeah.
But for the millennial generation in particular, it's just totally straightforward. You want to raise money, of course you're going to do it online.
Yeah.
And so when you go to invest in one of these deals online, like if you went up to sign up at Realty Mogul or Real Crowd or Crowd Street, it wouldn't look like anything surprising to you. You would register, give your name, all this information, and then you would see various deals. And, it would be like being at at a outdoor market where there's all different kinds of food, and you would see all different kinds of real estate deals,
Yeah.
different classes, multifamily, office, industrial, development. You'd see all these asset classes. You'd see some different deal structures, like some you'd become an equity owner, others you'd just be lending money to them. Others, there'd be a cross, what we call preferred equity. It's kind of a loan and kind of equity.
Got it.
And there'd be this, marketplace, and you'd walk around and say, yeah, here, I want to invest in that one and in that one and in that one. And you would find it very straightforward. And actually, I always say the best way to really get a feel for real estate crowdfunding is to do exactly what you suggested. Go to a few of those sites, sign up, look around, and you get a real feel for what the whole thing is about.
Got it. And can anybody invest in those real estate crowdfunding? Do I have to be unaccredited? So I remember when that Realty Mogul came out, you had to be accredited, I think. And then was there a new law that was passed that said that you don't have to be accredited anymore? Or what's the current regulation on investing in those?
So it is possible. So there are three flavors of crowdfunding. We call them by titles based on what section of the Jobs Act they were in. There's Title II, Title III, Title IV. And Title II, which is by far the most prevalent, and Realty Mogul is all Title II, you do still have to be accredited only. Oh, I shouldn't say that about Realty Mogul. No, that's wrong. They also offer a different kind, Title IV or Regulation A. It's a different kind of crowdfunding,
Okay.
and you do not have to be accredited. So you could go to Realty Mogul right now, or really any of the other sites, and find deals that a non-accredited investor can participate in. And there's a lot of them, and there are some great deals, I got to say.
Got it. Okay, cool. And then do you follow Grant Cardone at all?
I know of Grant Cardone.
Okay.
And I hear the name a lot, but I
Yeah.
don't follow Grant
Okay.
Cardone, I guess.
The only reason I ask is because he does multifamily syndications, and he just came out with a fund that is, I think it's a crowdfunding fund because anybody can invest in it. It's, accredited or non-accredited investors can invest in the fund, and the minimum investment's like $5,000 or something. So I think that may be what, the Section 4 that you called it.
Title IV,
Title
which is
4.
also it's usually called Regulation A, and it's
Yeah.
sometimes erroneously called Regulation A+. But yes, 100% sure that you are correct. If he is offering such a fund, it is a Regulation A fund, and anybody can invest. The only difference between accredited and non-accredited is accrediteds can invest any amount they want, and non-accrediteds can invest. They're limited. In each deal, they can only I put in quotes, only invest 10% of their income or net worth, whichever is higher. Now,
Got it.
you'd be crazy to invest more than 10% of your income in a given one deal.
Yeah.
So the limitation is not much of a limitation, but there is that difference.
Got it. Okay, cool. And then can you explain the three flavors of crowdfunding? How are they all different? So we kind of got Title IV, but
Sure.
how about the other two?
Title II is the simplest, easiest, accredited investors only. Other than that, there are no rules. It's wild, wild west. And the reason is that a fundamental principle in our American securities laws, which date all the way back to the 1930s, is that wealthy people can take care of themselves. They can hire lawyers and stuff. Non-wealthy people cannot take care of themselves. They need the paternalistic arm of the government around their shoulders. And that has worked. Worked very, very well as a system for the last 85 years. And so that's what accredited investor is supposed to mean, like wealthy person.
Yeah.
So that now it doesn't so much mean wealthy anymore because inflation has eroded the test. 200,000 of income or 300,000 for a married couple, or $1 million of net worth without your house. Those the same dollar figures have been in place for more than 35 years.
Oh, wow.
So back 35 years ago, 200 of income was a lot more than it is today. But anyway, the idea is it means wealthy people. And that's why Title II doesn't have any rules, because wealthy people can take care of themselves. That's how the theory goes. So then I'll jump to Title IV because we were just talking about it. Title IV is like a kind of a public offering that companies go through. Very heavily regulated.
Okay.
Because non-accredited people can participate. You have to go through a whole SEC process. You file a thick book. It takes months and months and months. It costs many tens of thousands of dollars. Very highly regulated. That's Title IV, which is what Grant Cardone must have just gone through.
Yeah.
And the third is Title III, which is a very brand new concept in American securities laws. This is the one that you read about a lot, where there's no SEC review process, and yet non-accredited people can participate. And it's all done online. You can only raise $1 million per year using Title III, and every investor is very, very limited into how much he or she can invest. So it's for small company. It's very small. To tell you the truth, it's not working very well.
Really?
There are some glitches. But so that Title II, wild, wild west, anything goes. Title IV, very highly
Super
regulated.
regulated,
You're
yeah.
allowed super regulated. And Title III, small companies, small investments. You can think about it that way.
Okay. Do you know for Title?
And
Go ahead.
Go ahead.
I was saying, do you know for Title III?
Mm-mm.
For Title III,
You go. You're the host. You
thank you. Well, for Title III, then what is you said 10% for like Title IV, right? For the non-accredited. So for Title III, do you know what that percentage is?
It varies based on your income,
Got it.
but it's a lot lower than 10%.
Wow. Okay. Okay.
So what I was going to say is, your listeners hopefully are not trying to scribble this all down. I write a crowdfunding blog, and one of the many things, there's no marketing stuff there. It's just information. One of the many things I have there is a crowdfunding cheat sheet, which is a little table with the different kinds of crowdfunding and the rules that apply to each one.
Got it.
So you can always go there as a resource if you're confused.
Yeah, feel free to plug it. What's the website?
It is crowdfund and then ATTNY, like an abbreviation for attorney. Crowdfundattny.com.
Got it. Cool. Thank you. And then for Title III, are you allowed to publicly market for that, or is that only on closed friends and family or pre-existing relationship?
Nope. For all three, Title II, Title III, and Title IV, you are allowed to publicly market. Title III has some restrictions, but not worth talking about unless we got into a really granular discussion. But that's the thing about all three of them. From a developer's point of view, you're marketing your deal, whether it's 2, 3, or 4. You're marketing it to every investor in the world.
Yeah.
Which is an incredible change for what the rules used to be.
Yeah, true. Okay, cool. And then is there a new tax law that should boost crowdfunding that just came out recently?
Well, not really. I mean, the 2017 tax law did a couple things. One, it provided for a special deduction for investments made through limited liability companies and partnerships. So you can, in a real estate deal, potentially get a bit more of a deduction, although in real life that has not proven to be super important. And the other thing the law did was created these opportunity zones, this concept of special tax benefits for investing in, economically distressed areas that have been designated as opportunity zones.
Yeah.
And there is a lot of activity around opportunity zone fund investing, which generally does involve real estate, doesn't have to. But I mean, I should say, the law, real estate investing is very, very tax advantaged.
Yeah.
And always has been during, during my whole career. So the 2017 law did add a couple little goodies, but it's already, real estate is a great tax advantaged investment.
Got it. Okay, cool. Now let's move over to blockchain. So first of all, what the hell is blockchain?
What the hell is it? You tell me. Blockchain is a technology that keeps track of things. And the reason I kind of chose my words carefully is it is, I know there are going to be a lot of the blockchain, engineers here who are going to, no matter what I say, is going to say, he didn't get that right. But that's basically what blockchain technology does. It keeps track of things. It just keeps track of them in a different and arguably a much better way than we already have for keeping track of things.
Yeah.
So you can think of blockchain. And again, lightning is just bolts are going to hit me when I say this, but blockchain is sort of a super duper Excel spreadsheet, a super duper spreadsheet technology, a way of keeping track of things that the principal advantage of it is that you don't need any central authority to manage the spreadsheet. Like if you were to keep track of anything in your life, a list of your friends or the real estate investments you own or all your possessions, to make a change to that, right, it would be you, the central character, making a change. And even if you and your friends, a group of your buddies got together and made a list of all of your investments or anything, you'd have to designate someone, okay, you're in charge of making changes to this, right?
Yeah.
You'd have to have a central trusted, that's the key, trusted person making the changes.
Yeah.
In blockchain, you don't need a central person making the changes. Everyone on the blockchain has to consent, that's built into the technology, for any change to be made. So we call it a trustless technology, a trustless distributed ledger technology. But if I'd said that in the beginning, you would have said, "What the hell does that mean?" He's just using, he's just making shit up. So, but that what that boils down to is a super duper Excel spreadsheet. So that's what blockchain technology is.
Got it. Okay, cool. And then how do you think that that's going to affect real estate? I mean, I saw last year that, the first house was ever sold through the blockchain or whatever. But do you think that, what's the point of it? So how is that going to affect real estate? So
Right.
a normal
Great
real
question.
estate investor, how is that going to affect me?
Normal real estate investor is not going to notice it even one single little bit.
Wow.
So, do you think so? Spreadsheets came out in the 80s and 90s. Did anybody notice that their real estate title company was now using spreadsheets?
No.
No, they didn't. What they might have noticed was that the time that it took for the closing title clerk to make her calculations
I got you.
was a lot faster. And therefore, maybe the cost of the title company came down a little. Okay. And that's the same as when the telephone or the title company started using a personal computer and email and the telephone, the fax machine, FedEx.
Yeah.
People started to notice that, hey, you can do things faster nowadays. So on the one hand, blockchain absolutely will permeate the real estate industry. Everything from how we keep track of deeds, like who owns the real estate, to environmental reports, to the closing sequence of events. Eventually, many people believe it will all be handled on the blockchain because the blockchain is just really good at that stuff. But no one will notice.
Yeah.
As a real estate buyer, you won't care.
Yeah.
You won't notice. If you walk in a room and flip on the light switch, do you notice whether the electricity is being generated by natural gas, nuclear energy, or wind?
Yeah.
No. It's a super important change, right? And you might be saving a lot of money or helping the environment, but when you flip the switch on, as far as you're concerned, the light just comes on. And that's how it'll be for the real estate industry also.
Got it.
There's been way too much it's beyond funny about how people have talked about blockchain revolutionizing the whole world and getting rid of the banking system and all these things. That's not in the cards. It's just going to be another really significant change that you're not going to notice.
Got it. And why do you think that it hasn't caught on yet? Why is the escrow company not using blockchain yet? What is stopping it from being something that all the escrow companies and all the closers can use to speed up that process?
There's a the answer to that question is multifaceted.
Yeah.
Meaning, I don't know.
Yeah.
Meaning, there are a number of reasons. One, the blockchain so far is slow. It's way too slow to handle the number of transactions. Okay, so like the old technology, like used at say MasterCard. MasterCard's definitely looking at blockchain technology, but MasterCard handles like 1 billion transactions a second or something, and blockchain is way too slow. Another constraint is that at least some of the blockchains use a massive amount of energy.
Yeah.
Because the way this works with a distributed thing, Everyone's computer has to be involved. I mean, massive. You wouldn't believe how much energy they use.
Yeah.
And the third thing is that converting an entire system, business model, from one kind of backbone to another, to blockchain, is an enormous task.
Yeah.
It's not something that you can do just a little bit. You have to kind of move the whole thing over.
Yeah.
And businesses have not been convinced that the benefits of blockchain will justify that wholesale conversion, because although blockchain has all this promise, the existing technologies continue to get improved themselves.
Yeah.
Every month, every 2 months, every year, they get better, so that blockchain, the benefits of blockchain kind of get lower and lower as the competing technology gets better and better. I think many people still think it's going to happen and that there will be wholesale adaption, but it ain't easy.
Yeah.
It has not proven to be as nearly as easy as people thought it was going to be.
Yeah. Yeah, and also using all that power and all that data is going to be expensive too. So getting the price down too, where, like I said, a supercharged Excel spreadsheet. My Excel is free right now. Why would I pay all this money to upgrade to a slower system?
Right.
And
people don't necessarily want a trustless.
Yeah.
For example, if you're MasterCard, you're not looking to create a trustless ledger. You're MasterCard.
Yeah.
You're going to be the you're going to be the trusted person who manages the MasterCard system. And it's a real question whether consumers really want a trustless environment? Maybe they want, someone in the middle that they can blame or trust to manage the entire apparatus. So
agree.
We'll see.
Yeah, true. I think we still have some time for the technology to get better and more affordable, and then some big players have to test it out, I think, before everybody's going to adopt, Yeah.
I completely agree with you.
Yeah.
And I just personally, I think, based on what has happened, once it starts, if there is a future there,
yeah,
Amazon Web Services is going to be the central player, or Microsoft, or a few, Google. We're not going to have all these decentralized systems, just as everyone's business is built on Amazon Web Services, right?
Yeah.
I don't know why that wouldn't happen with blockchain technology also.
Yep. No, I agree.
I think.
And then, so how do you think blockchain is going to affect, in your space, the crowdfunding space? Are people not going to notice the effect? Only the people doing the crowdfunding
They won't. Yep.
Wow.
Yep. That's absolutely what I think. I mean, there are benefits. For example, we've talked about the differences between accredited, non-accredited investors. So it would be great if all that information, your accredited investor status, were on a blockchain, that it could just be pinged. Mm-hmm. And so we wouldn't, right now what happens is you have to get a letter from your accountant or a letter from your lawyer, and it has to be emailed. And so there's friction. And if information were on a blockchain, it could just be instantaneous. So we cut out a little friction.
Yeah.
I mean, that's what blockchain does well.
Yeah.
But will Mark Roderick notice that that's happening? No.
Yeah. And so that brings up a good point, right? So, like, if I'm signing up for a crowdfunding website or service and they're on the blockchain, but my accountant's not on the blockchain, or my financial information is not yet on the blockchain because I use a crappy CPA or something like that, then is the blockchain then worthless? Because not everybody is, there's there has to be a huge market share on the service in order for it to pull and gather the information, right?
I think that is right. That's probably a little bit above my pay grade. a blockchain engineer. But as an example of what you're saying, the promise of electronic medical records was that way before now, everyone's electronic medical records would be available to all their doctors, and
Yeah.
it would, you get this great improvement in care because everyone would be able to compare notes. That has been so far a complete total bust because of exactly what you're saying.
Yeah.
This doctor uses this system, this doctor uses
Hmm.
that system, the hospital uses a third system. Nobody talks to each other at all.
Yeah.
It's great. It's digital information. Doesn't matter. It just sits on a server and is never used. So, yes, that's probably another impediment to
Yeah.
widespread adoption.
Yeah. Yeah. There was
You
another.
got to get,
Yeah.
yeah, go ahead.
I was saying there's another example like that. It was the police and all their reports about all the criminals and all the incidents or phone calls for a certain person were on record with the police department. But then the FBI and all these other government agencies didn't have any record of that because they were on a completely different system. They're all under the
Yeah.
government, but they don't have any, they're not sharing any information. So again, it's like a bust. There's no point of having even one system because not everybody else is on the same thing.
That's right. And that's, one of the things about technology is it ultimately, like it or not, it depends on human beings. It depends on the behavior and the adaptability of human beings. And human beings, we are just a really difficult species,
Yeah. Yeah.
And so the technology can be great, but I mean, here's a stupid example. The keyboard you are sitting in front of right
Uh-huh.
now, and the one I'm sitting on in front of right now, the so-called QWERTY keyboard, because of
Uh-huh.
the letters on the top row. We have known forever that that is a very, very inefficient keyboard, right? It was created to be inefficient because back when typewriters were in use, mechanical typewriters, they didn't want you to be able to type very fast because the keys would hit each other. So they arranged the keys to make it as hard as possible to type back in the day. And we've known since computers were, I've been alive, an adult, when computers were invented. And one of the things people used to talk about is, oh, great, now we can get rid of the QWERTY keyboard and everyone can start using a keyboard that's much easier to use and faster to type. Well, it's 2019, and what keyboard are you using today?
Wow.
It's an inefficient keyboard. The better mouse doesn't win all the time
Yeah.
because once you have a system that everyone is used to, it's really hard to get people to change.
Hard
So
to
there you
move
go.
off it. Yeah, no, that's very true. Now let's talk a little bit about REITs and crowdfunding. So REITs are, first of all, can you explain a little bit about what a REIT is, a real estate investment trust?
I would be happy to. And again, there's articles about this on the blog. A REIT, contrary to many people's belief, is just a tax designation. If you jump through a bunch of hoops, like lots of hoops that are described in Section 856 of the Internal Revenue Code, you become a REIT. And the only characteristic of a REIT that matters is that a REIT doesn't pay tax. It is not a taxable entity for federal income tax purposes.
Wow.
And that's all a REIT is. It is a tax entity. So, in other words, if it weren't for the REIT statute, if you created a corporation and it went out and bought real estate and stuff, it would have to pay tax. And then when it distributed its income as dividends, then the shareholders have to pay dividend taxes. And way back when REITs were created, this was an idea that, hey, this kind of allows individual investors to invest collectively in this entity and pay only a single layer of tax. So that's That's what REITs are. They are a tax entity. Now, fast forward to today. We have a lot of entities today that don't pay tax. Limited liability companies, for example, don't pay tax. Their income flows through to the owners, right, on a Schedule K-1. And so, speaking from a 30,000-foot peak, the difference between a REIT and just a garden variety limited liability company boils down to one very simple thing. And that is, if you are the owner of a limited liability company, at the end of the year, you get this thing called a K-1 to report on your personal tax return. And K-1s can be really complicated. Whereas if you're an owner of a REIT, all you get is a very, very simple 1099, just like the kind you get from your interest-bearing checking account. So the tax reporting for a REIT is much, much simpler than it is for owning an interest in an LLC. And believe it or not, that is the main reason that we use REITs for crowdfunding. Because when we're doing like a Regulation A offering, where like the kind you were talking about, where you could invest as little as $5,000, we figure we're going to get a lot of investors who have very simple tax returns, and they don't want to have more complicated tax returns. So we do a REIT so that they can just get a 1099 rather than a K-1, believe it or not. That's why we do it.
Got it. Okay, so every time you do a crowdfunding campaign, it's through a REIT?
When we do Regulation A offerings, which are going to involve up to $50 million, raising up to $50 million, and where we're letting non-accredited investors participate. In the Title II world, in contrast, we're only letting accredited investors participate. We figure they already have more complicated tax returns. So getting one more K-1 for an accredited investor doesn't matter.
Got it.
It's okay.
And then for that, then would you use just a basic LLC or a partnership or?
Basic LLC.
Got it.
The entity of choice is a Delaware LLC. That is the crowdfunding entity we always use.
Got it. And why Delaware?
It's easy to spell. No, that's a joke.
Can do Ohio then.
Yeah, I was just going to say Ohio. Now, there are a couple of benefits to Delaware. One, because Delaware has always been used, like every public company is a Delaware corporation.
Yeah.
Lawyers all over the country are comfortable with Delaware and know that if there's a Delaware entity involved, it means their clients are not being ripped off.
Got it.
So everyone's comfortable with Delaware. That's not a very good answer. Another reason is that Delaware laws are very, very good. They're very clear.
Okay.
They give us a lot of flexibility. Another thing is that Delaware has a very good court system, a business-only court system that allows disputes to be resolved in a very good way. And
Awesome.
Finally, Delaware law allows us to protect the sponsor from lawsuits.
Okay.
And because the sponsor's the one hiring the lawyer, we choose the law that protects the sponsor. So for all those reasons, that's what Delaware is about.
And that last point that you said is that the same thing as that people say, like, oh, it's a non-piercing state? Is that what you mean? It protects the sponsor?
Yeah, piercing is usually a different issue, but
okay.
And it's a little bit complicated legally. Suffice it to say that Delaware offers the greatest. There's no state that offers better protection for the sponsor than Delaware.
Got it. Awesome. Cool. Well, what's the best way for people to reach out to you, about crowdfunding, blockchain, law, if they need to hire somebody for their next crowdfunding campaign? What's the best way for people to reach out to you?
The blog. I won't even bother to give you my email address because it takes so long. It takes 4 hours spell. But if you go to the blog crowdfundattny.com, you will see all my contact
Cool.
info. I'm sure there's a button somewhere that says contact me. That
Awesome.
is definitely the best way.
Awesome. Awesome. Thanks so much for coming on the podcast and sharing your wealth of knowledge about crowdfunding and blockchain. And yeah, thanks for coming on the show.
Thanks very much. It was a pleasure.
It was a pleasure. Thank you.